G'day everyone, welcome to this global update for Australia and also for international stock markets for the 23rd of November. And it was another week of similar activity with American markets hitting new all-time highs and a continued really strong rebound in Germany, in England. Certainly the Shanghai Composite Index is doing very well. Everyone's doing very well except Australia. So we really are missing out on this global rally that's going on, and that's why I've been basically rabbiting on all year about shifting a significant part of your exposure to offshore, because that's where the opportunities lie. So let's have a look at the action for last week. The American stocks, first of all, the S&P index ended up gaining 24 points on the week, so another really solid week with all the indices going up. And there was a bit of an acceleration to the upside at the end of the week as well, with the announcement by the ECB and also by the China Central Bank as well on Friday that they were actually reducing interest rates. So we did see an end of week acceleration, and the S&P ended up over 1270 at one stage on Friday night. Now, as you'll see from the chart, in the very short term, the market is overbought. But so we could see a bit of a pullback. It really is a long way above the moving average. But the fundamentals do support the market going higher over the medium term. But just look out for buying the dips and not the advances, because the market has run a long way in a fairly short space of time. So let's just have a look at that. So there's the S&P 500. We had a dip in early October, which certainly wasn't supported by any reasonable fundamentals. And I'm of the view that I think it was a bit of a manufactured decline to advantage some of the bigger players who were looking for a bit more volatility. You can see the market rebound has been spectacular, and it's just roared ahead. Now, short term, we are overbought, so wouldn't be surprised to see a bit of a pullback, perhaps to the 2020 area, and I think that would be a good foundation for the next move higher. Just while I'm here, let's just have a look at the Australian index. In fact, now before we do that, let's just have a look at the German DAX. So the German DAX, you can see I was looking for, I felt that we were into a phase 4 decline. All the indicators that I use, the break of these lows through here about 8,900, all of those things all clicked in, and I thought we were in a phase 4 decline. However, the ECB has now stepped up with their money printing, and that has just overridden the normal chart patterns. And that's what's been happening over the last few years, that the normal chart patterns that you would expect are just being swamped out by the actions of central banks, by continuing to flood the world with funny money. So this is just the way that markets are these days. So you can now say that the phase 4 decline in the German market is now not happening, and we're now back into this big sideways washing machine, where basically the fundamentals would suggest that the market should go down in Germany, but the increase in asset prices is holding it up there. Seeing the same thing in England, although in the UK the fundamentals are better than in Europe, but the same pattern is applied here. We had a steep dip, but equally a steep rebound as well. So we'll continue on with those markets in Europe doing what they're doing. Let's look at the Australian market, however, by comparison, and all the other markets are going up, and our market just awful. Really is a very sad picture in the Australian market, and with all the global markets rallying last week, you think we could have done a little bit better than this. We closed lower every single day last week. So very disappointing in the Australian market. So just to recap, German DAX, the phase 4 decline is now negated, and thanks to the ECB, and the FTSE the same. The ASX 200, fell 148 points on the week, which is just amazing. All sectors, including the banks, were down. Now, we will, of course, reach a point where the dividend yields on the banks and some of the major stocks like Wesfarmers and Woolworths will just start to become appealing enough that buyers will step back in. And we're probably not that far from that point. But gee, it's really hard to feel confident about doing anything in the Australian market when you see the sort of action that we had last week. Everyone else is going up and we're down by 148 points. It really does tell you about where our market's at. Looking at commodities, gold $12 higher for the week, finished above 1201, so that was important to get back above that level. And as we'll see from the chart, we reversed off the 61.8% retracement level. So technically, it's a start of a good rebound, but really to demonstrate that there might be some more substance in this bouncing gold, we need to close above 1250. So we're not there yet. Now, if gold is going to head lower, and I don't rule out that possibility, then there is major support at 1,025. And then if that support level breaks, and I guess we're talking definitely bigger picture, so this could unfold over a period of 6 to 12 months. If the support at 1,025 fails, then we're looking at 850, which is obviously a long way south of where we are now. It seems hard to imagine, but these days, I don't rule anything out. And one of the things that could cause that, of course, is if the US dollar rally continues to show its strength. So the euro going down, US dollar going up, and that's just putting pressure on the gold price. So I wouldn't rule out 850 as implausible as it would seem, because a lot of mines would be shut well before that, which would definitely be affecting the amount of supply of gold. But there's so much strength in the US dollar and the US stock market that I wouldn't rule it out. Now, stock indices have also rallied back to their breakdown level, but haven't yet got back into the range. So let's look at these fairly important charts surrounding gold and the gold stock indices. Let's just move forward. I'll just look at a slightly different chart this week. Just to get there, there we go. So this is a weekly chart of gold, and I want to pan back and take a big picture look at this. Let's take a big picture look at this particular chart. So you can see if we run, this, sorry, just trying to get rid of some notation here. Just let me get that out of the way. So if we run a Fibonacci retracement level to the last major low that we saw, which was basically after the GFC, so the 24th of October. That was the last major low at just under $700 an ounce. So you can see that we had a retracement level, the third retracement level at 1154. We dipped under that intraday, as you can see just recently, but then bounced back up again. Now remember, this is a weekly chart. So we broke these important lows at 1188, which could be just technical because they were broken very, very briefly. And you can see here that we've just rallied back up into that range. So it just opens the window as to a possible bottom, long-term bottom in gold. But to demonstrate that that is the case, we need to get above this previous peak, which occurred in late October around the 1250 mark. So until we get above 1250, I don't think you can draw any conclusions. Now, we have had a break of important support, so it is possible a decline down to this old peaks down here, which were formed in March of 2008 at 1125 is possible. If that fails, then I'd be looking for the next support down here, picking up off these lows of 2009, and that's about 862. So that's the big picture on gold. We definitely need to see a close above 1250 to feel like like there's a low in place. Now just moving to the GDX index. So the GDX index is, you can see we've had a lengthy phase one base. I expected that phase one base to resolve to the upside, but instead it broke to the downside. Now we've rallied back to that breakdown point, but not back into the range. So we're at an absolutely critical level for gold stocks. I think if you see gold stocks move strongly back into this range, we can get the GDX index up above $22, then I think you're a real chance on gold being into a new bull market. But until that occurs, it's really hard to feel confident about what's going on with gold. Now copper, steady on the week at 307. It's still holding support, but it's still in a big declining wedge pattern. The reason that I highlight copper every week is that it's such an important barometer of global growth. So it's pretty consistent with what we're seeing. We're seeing slow growth. But of course, things could come unraveled in Europe and possibly in China. Now also crude oil was steady on the week at around $76, so neither of those commodities moved. Crude oil could continue lower based on supply and demand, but certainly a rebound in US oil stocks could be signaling a medium-term low. They certainly did better last week. Here's the spot copper chart. Not a lot of change between $3 and $3.10 for several months now. So overall, the strategic approach remains unchanged to my way of thinking, and last week in Australia absolutely underscored that. You really should have a heavy emphasis on key US stocks because otherwise it's, if you're just in Australia only, it's just too hard to work at the moment. So emphasis on key US stocks. Members, of course, know what those sectors are and what the stocks are, and the stocks in our members' US portfolio are going absolutely great guns. So we're picking off, grossly oversold and financially robust stocks, and that's really just the way to play it. So that's it for this week. If anyone would like to, who's a non-member, who'd like to talk to me, members get to talk to me all the time, of course, but if you're not a member and you want to talk about trading and investing, then there's my email address. Happy to do so. Let's see what next week brings. Cheers.